Let's start with Europe, if we could, and the prospects of a possible European oil embargo on Russia. Not clear that'll happen. Hungary's reluctant. But I guess my question is there further upside risk to the price in crude right now because of what might happen with that?
Oh, absolutely. I mean, look, ultimately, we do think Europe wants to do an embargo, regardless of all the headlines we've seen yesterday about the U.S., trying to propose a tariff instead of an embargo. Of course, a tariff would be less disruptive because, it just means the price of oil would, for Europe to import from Russia, would be much, much higher. But equally, Russia could discount its oil and still send it, right? So the U.S. is proposing that because, of course, inflation is a big talking point everywhere really in the world, but particularly in the US ahead of the midterms. But from our understanding and our sources, Europe still wants the embargo. The meeting on the 30th and 31st of May in Brussels is going to be the key one to watch out for. Hungary ultimately wants concessions, and Europe is working on it. Exactly how that kind of pans out remains to be seen. But we still believe that an embargo is on the cards.
If in fact there were an embargo, do you have any sense of how high the price of oil could go?
I mean, look, the embargo doesn't hit oil straight away, right? Because this is going to be a phased embargo. It'll take about 6 months to really phase this out. So that upside comes at the end of the year, because by that time, the SPR, the IEA and US SPR will also have ended. I mean, we've already seen oil prices around $115, $120 per barrel. But let's remember, if you talk about the price of oil, what you and I are paying for, whether it be gasoline, diesel or jet fuel, that's already above 160, 180, in some cases even 200. So we are already there. It's just a question of the combination of crude plus products, which one you're looking at. But crude could easily go to 150 on its own if things really tighten up towards year end and further SPR releases don't happen. Now, we do think there will probably be more SPR releases, but ultimately it's still finite, right? You do run out of SPR, and I think that's when ultimately you need demand to come off to balance this market.
Amrita, let me move over briefly to the question of natural gas in Europe as well, because we now have the EU, the European Union, saying you cannot pay in rubles. Russia saying you have to pay in rubles. I saw a report in the Financial Times today saying that maybe Eni was going to defy that order. Where do we sit right now with natural gas supplies and the question of whether they can be paid in rubles?
I mean, this has been going on for some time, but not just Eni, like you said, but quite a few others have also come out and said that the payments will continue. Special arrangements, you have to pay into Gazprom Bank, which then converts it into ruble and sends it to Russia. So we think that will continue. We've highlighted there's about 9 BCM of potential gas contracts that could get closed off before the end of the year because they're up for renewal. But the bulk of it, like well over 30 BCM, will still continue, and the payments will just take place regardless of EU saying that they can't be paid in rubles.
Amrita, if in fact there's further curtailment of the purchase of oil or gas from Russia, there's the natural question of, okay, where might that oil or gas come from? What substitutes are they? Start with the United States. Producers here have been fairly disciplined in saying we're not going to ramp back up again. Do you expect that to continue, or at some point with the prices escalated, should we see a ramp up in U.S. production?
U.S. production is rising. It's just that it's not rising by anywhere close to what it used to at, say, $100 oil. Part of it is producer discipline, as we've seen, and we've just come out of earnings season. Regardless of prices being close to $100, guidance didn't really go up at all, barring one or two of the oil majors, and I think that is really telling. But also, I think even if they wanted to, oil field services is the biggest constraint right now. When I was there just a few weeks ago, you could, even in the Midland at a frac site, you could see how short labor was, equipment, steel, cement. 55% of global casing is Russian steel. So I think there's some genuine tightness in oil field services that's perhaps being underappreciated, regardless of what happens to prices and capital discipline. U.S. producers will really struggle to raise production this year. Next year, they've started to place orders for rigs in advance, so things could get a little bit better. And that's where capital discipline comes in more so than this year, I'd say.
Amrita, last time I checked, the largest proven reserves were actually in Venezuela, which has largely been closed off. At the same time, there are announcements now that the U.S. may be backing off on some of the sanctions, permitting more activity. Is it realistic to expect Venezuelan crude to come into the market and help some of the problem?
Look, I mean, these are very early days. Yes, some headlines that some economic sanctions could be lifted, and potentially Chevron could get some preferential treatment where they could get some of the oil back to the U.S. But very, very early days. The biggest issue with Venezuela is that the damage that's been done to the upstream over the past decade or so, if not longer, or decades really, is huge. I mean, PDVSA's own documents will say you need tens of billions of dollars to really get production up and running. So maybe even if, again, that's a big if, but even if all sanctions get lifted in the near term, maybe production rises by a few 100,000 barrels per day, 200,000-300,000, or maybe max 500,000. Anything more than that is going to take years, and that's the problem. And again, I repeat, we are nowhere close to being, or we're nowhere close to saying that all economic sanctions or all sanctions overall, including oil, are going to get lifted. These are just small steps to see how the next kind of potential talks progress.
One last one here, Amrita. We've been talking about crude oil. There are the refined products, which are related but somewhat different. We've had a real constraint, as I understand it, in the capacity to refine. And as a result, you've got a real spread now of things like diesel and jet fuel. Is there any prospect of increasing capacity in refining in the medium term to relieve some of that pressure?
Well, like I was saying, right, crude could be 115, but diesel and jet has been closer to like $200. Look, in the near term, we've obviously closed down almost 3 million barrels per day of refining capacity in the Atlantic Basin during COVID, and even now because of ESG pressures. China's policy has changed. It doesn't export as much products as it used to, and that's why these pressures are going to stay. From now on, we are finishing up refinery maintenance, so some of the acute pressure that we are feeling will ease off in the coming months. But fundamentally, or structurally, I should say, we are going to be short. There are some new refineries starting up in the Middle East, one potentially in Nigeria and one in Mexico over the medium term, but they are going to be nowhere close to meeting the oil demand growth that we are forecasting. You really need a deep, deep recession for oil demand to decline outright, and only then will you be able to balance the market. So the ESG pressures are really hampering downstream investment and refining right now, which is a big concern for the global economy, really.